Welcome to the Ontario Multifamily Investment Podcast, where we interview leading experts in their fields to make market intelligence accessible, understandable, and actionable for owners and managers of multifamily properties in the province of Ontario.
Hi, everyone, and welcome to the first episode of the Ontario Multifamily Investment Podcast. With rising interest rates being on the minds of every apartment investor, I can't think of more appropriate guests for our first show than my guest today, Adam Powadiuk and Aaron Cameron from First National Financial, who many may not know is Canada's largest lender of CMHC insured mortgages and Canada's largest lender on multifamily properties. Aaron is Assistant Vice President of Commercial Operations at First National, and Adam is Assistant Vice President of Commercial Financing, where he and his team originate over $2 billion in commercial loans each year. In this episode, we talk about commercial mortgage rates and the bond market that influences them. We talk about the current multifamily lending environment, both for acquisitions and also for new developments. We talk about global factors affecting inflation and their effect on the multifamily industry. And we talk about one of this year's truly positive developments in multifamily lending, CMHC's new MLI Select program, which offers various incentives for properties or developments that meet certain criteria. Whether you're an experienced apartment investor or thinking about your first purchase, I think you'll find this episode informative and a valuable use of your time. The goal of the podcast is to interview leading experts in fields that are important and relevant to Canadian multifamily investors with a particular focus on the province of Ontario. Please be sure to sign up to receive future episodes by going to ontarioapartmentgroup.ca/podcast. If you like the show, please help spread the content by rating and sharing it. And if you'd like to speak with me directly, all my information's in the show notes. I hope you enjoy the show. Adam and Aaron, welcome to the podcast.
Thanks, Derek. Good to be here.
Excited to have you on the show. Before we get started, for the benefit of our listeners, why don't you introduce yourselves and give a bit of background about your roles at First National?
Aaron, you want to jump in with your origin story?
Who's more interesting? Whoever's more interesting goes second. I can answer that question, but I'll go first. Mine's easy. I started at First National straight out of university with a short pit stop teaching English in Korea, but for the most part, started my career at First National. I started during the financial crisis in 2008. So quickly, the reason they hired me no longer became a reason to hire anybody in our single family department. And so I got moved for no good reason to the commercial department, other than, I guess, in commercial loan administration, they still needed people. And that was just very serendipitous or just fortunate that I ended up there. And then from there, I've spent the last 13 years working in our commercial department, working in basically every department there is in our commercial division. I now find myself running the operations for our commercial group with pit stops and servicing, credit, sales, now kind of run the operation side.
I'm the counterpoint to that. I'm on the sales side here at First National, but my real estate story started a long time ago. Coming from a real estate family, my dad is a developer. So I was kind of steeped in real estate culture from the time I was born, which is, a fantastic transition into real adult life and getting into real estate. I did have another career in my 20s, but I went back with my original plan to get into real estate around 29. And then I spent a couple of years at Colliers doing industrial sales and leasing. Had a great experience there, but I got a great offer at First National to start as an analyst, which is probably the greatest learning period you'll ever have in your real estate career. You're just exposed to so much, every asset class, so many markets, just the proverbial drinking from a fire hose and trying to absorb as much as you can. And then started into sales. And I've been doing that for the last 8 years with a primary focus on apartments. I spend a lot of time in the Ontario market and the BC market.
Speaking about drinking from a fire hose, there really is a fire hose of information and of opinion coming at investors right now as various voices in the marketplace are looking at the current situation and offering their thoughts on what we might see in the future near term when it comes to the lending environment in general. And interest rates in particular are obviously top of mind for anyone who's active in the space. What are you guys seeing just on a high level on the financing side for deals on existing product and also for new construction financing?
Are we trying to share the good news here or the bad? Are we playing to the audience? Because I assume this is mostly apartment investors, but I would say that humans have a tendency to focus on negatives. Of course, it's just in our nature. And there is definitely some negatives in the marketplace. You mentioned construction, increasing costs and going on for quite a while. That's a multi-year story in itself. And then, more recently, obviously, we've had major issues with interest rates going up and the impacts that has on our arena of the world lending impacts it negatively, and that we obviously cannot lend as much money. And the cap rates and interest rates are intertwined. And, we're currently at a period where you keep hearing price discovery is the term, but it really means we're not quite sure what these things cost these days. And so it's a moment of flux, a moment of quite a bit of fear in the market, but there's also a lot of reasons to believe in the apartment market. Rents are strengthening in virtually every market I looked at. I mean, Aaron, I don't know if you've seen anything flat across the country, but everybody you talk to across the country, it's rents are up, rents are up, rents are up. And that's one of the best news stories we've got in the apartment sector right now.
Best news if you own apartments, not the greatest if you're a tenant, right? Before we move on, I guess we should mention Adam and I got introduced to Derek, or Derek discovered Adam and I through the Commercial Real Estate Podcast, which is a podcast that Adam and I have been doing for half a decade now, right? 5 years, 6 years?
2016 first episode.
There you go. If you like what we say, you can find us. Derek, not to diminish from the podcast we're doing right now, but I think that's part of the value, right? Is that we get cross exposure. So, of course, you can find the Commercial Real Estate Podcast on any podcatcher that you use. The reason I bring that up is because you're going to find us referencing things that we've already discussed. And I find it difficult at times when we have these conversations with our guests through the CRE podcast that it's a great thing. Rents are going up for a certain segment of the population, but it also is a challenge. Like, let's just acknowledge when I talk to our clients, First National's clients, or our guests on the podcast, and I think the same thing for you, Derek, your clients, is we're in the business of housing Canadians, right? We're in the business of creating community. And ultimately, the best outcome is that, we're driving profit as property owners, but you're creating a safe, clean, enjoyable environment for your tenants, for the Canadians that live there. And balancing profit, of course, it's a capitalist society, so that's important, with all the other reasons why you get into owning real estate is a challenge. And so, yes, we are in a weird scenario where there are a lot of headwinds facing the apartment community, particularly on the development side, but I don't know if we're going to get there tonight or today, but there's a lot of cost escalation from development charges to all your inputs to labor, etc. Interest rates, of course, being the one. But if you're just owning an apartment building, of course, you've got inflationary pressure, right? Whether it's your utilities, your insurance, we can talk about a hardening insurance market. But of course, your biggest cost of operating an apartment building is your debt, which is up. I mean, Adam and I being lenders, where are we now? Today, the Government of Canada bond is 2.8% for a 5-year. Are you okay, Derek, if I date stamp this?
Of course.
Let's say it's late July. We've had a bit of a bond rally in the last 4 or 5 days. We're actually down 35 basis points from where we were a week ago, but we're still, highest point 45 days ago was 3.5% for a 5-year Government of Canada bond. We're now at 2.8, so we're down 70 basis points from our high, which is still up 150 basis points from the start of the year, right? So 6 or 7 months in, rates have more or less gone more than double and are almost, in some instances, tripled, which means, of course, if you own an apartment building, your cost of borrowing, if you're refinancing or your loan is matured, you need new leverage, or you're buying something, it's really, really expensive. Fortunately, and this is the fortunate part, is rents have experienced both supply and demand pressures, which have caused the rent increases across the country. And fortunately, depending on your perspective, predominantly in major areas, particularly Toronto and Vancouver, but you're seeing it in all strong rental nodes, let's put it that way, where renting is a strong part of the economic fabric. We're seeing a lot of pressure on rents. And I guess for apartment owners, for our listeners, that's a really good thing to save them with the additional costs they're experiencing.
From your perspective, are you seeing a slowing, or has deal velocity remained fairly steady? Are transactions moving forward? And I guess I would separate that into two parts, the acquisition side and the development side. Is the velocity remaining fairly constant, and are transactions getting funded and closing, or are you seeing a slowing?
I've not seen any construction project I'm working on get shelved, although of course, if you read the headlines, it is happening. So not to say that, my experience represents the broader market. Some are for sure being put on pause, but, the majority are still proceeding. So that's kind of the good news story there. And a lot of the projects that did get paused tended to be in the condo market, not in rental. So for specifically to the apartment investors listening to this, that is relevant. And then on the acquisition side, I've definitely noticed a slowdown and a number of haircuts in properties that were previously under contract back in February, March, April. If you put some under contract then, you ran into trouble because bond rates went up so much. So we saw haircuts on purchase prices. But of course, now we've been at these higher interest rates for a handful of months now. So But you're not going to see that as much going forward because the market will have adapted, will have factored in that you're paying more for your debt. Related to that is you also can't borrow quite as much. So people's equity chunks were widening out as the market adapted to this new reality. I know, Derek, we would put it back to you then, because obviously, you're seeing a lot of this as well. What are buyers thinking about?
Wait. Who's interviewing Hugh?
Well, the year started like 2021 ended with record values and cap to interest rate spreads very tight, despite the cost of debt being at unprecedented levels. There was a sense in the market of how much longer will this continue? And there was, of course, an understanding that the low rates wouldn't always be there and that any significant increase would change the dynamics of the market. So there was increased demand from buyers to get buildings under contract before the lending environment changed. Even if it meant the tight spreads and the high price per door, purchasers recognized that with few exceptions, unless an apartment building has had 100% turnover in the last 12 to 18 months, pretty much everyone's rents were significantly below market. And so buyers were willing to pay for the future now with the expectation of improving the building's financial performance over time. But again, we knew that things would change sooner or later. Nationally, we hit 4% inflation last August. By January of 22, we were at 5%, and by March, we were over 6.5%. And so when the bank started to move its policy rate in March, even though they started slow because they wanted to see how the market would respond, I think there was a general sense that at some point the gloves would come off, which they did in the second quarter as the bank raised its policy rate another 50 basis points in April, another 50 in June, and then the supersized increase of 100 points in July, which started producing some gapping out between buyers and sellers on pricing, not because of pessimism in the market or waning demand, but because there was uncertainty about where rates were going, which led buyers to be more conservative in their underwriting. But in perspective, we're coming out of an environment that's been nothing but tailwinds in 2021 with these unprecedented low rates and high demand that made sales possible that, quite frankly, only a few years ago probably wouldn't have happened. So I think it's important to realize that, as was said, that kind of environment wasn't going to last forever, and that bringing some balance and stability to the market is a good thing, and not only good, but necessary. Here and now, deals are getting done. In some cases where the economics of a deal are just a little too tight now, sometimes the vendor will participate in seller financing to get things done. We're seeing a little bit more of that than we have in the past few years.
Well, we keep hearing that return of the VTB. I mean, not that VTB has disappeared in the low interest rate environment, but that's the feedback I keep hearing is it's going to be very, very common structure as buyers try and maintain the prices that existed back in February.
Well, I think the volatility has created some uncertainty about where cap rates should be in a given market. Like you said, Adam, price discovery. There's the question of where the spread should be, but then factor in the larger, well-funded buyers who have capital they need to place and because of their liquidity are a little less affected by rising interest rates. They may still be willing to pay those lower caps for the right asset just to get control of the property and realize the upside over time. That option is not available to the buyer who has less liquidity and needs to leverage their financing. So it does create an opportunity disparity, which has always been the case. Buyers with more liquidity have an advantage, but I think even more so in today's environment.
I totally agree, Derek. And I have two interesting conversations that come out of that in my mind. One is just, as you kind of alluded to, that there are different sources of capital for property investment, real estate investment, and apartment investment in particular. I was golfing with one recently who works for and with an organization, that international fund manager, whose amount of money that they play with starts with a B. And they're still active buying apartments in Canada and other geographies. And they're just not taking debt right now. They can't get a mortgage at an interest rate that is accretive to increasing their yield. But it's still not good, but it's at least better to deploy the capital and earn a 4 cap, right? A 4% unlevered return on that cash flow than to not deploy that capital at all. And that's just because they have other motivations, right? They have to get the money out rather than sitting in their account. They've raised the money through their fundraising initiatives. They have to invest it, and they're just buying it unlevered and sitting on it. Now they're buying things that typically have 9 figures or 8 figures or whatever. Like we're talking like 40 million, 100 million. Like that's the type of projects they're looking at, but they're just not taking on debt. Most everybody in the industry doesn't have that luxury. And so you do have those that are deploying capital and just not taking on debt, but almost everybody, I think there's probably, I don't know, Adam, what do you think, 10, 20 institutions in the country that can just happily buy without leverage. And that's a good solution for us, right? In these trying times with really expensive mortgages. For the most part, though, everybody needs to put on debt. And this is where I think it gets really interesting, Derek, because your comment about people buying on a 4 cap, the prevailing interest rates today are, let's say, 4.5. Again, we can talk later about where they really are and where they're going. But buying a 4 cap and then taking out a mortgage at a 4.5 cap is negative leverage. I don't want to get too complicated, but if you do the math, you're losing money. You're amplifying the money you're losing by taking on a mortgage at an interest rate higher than what you paid for.
You're making less. You're not losing money. You're just making less. It only affects part of the capital stack, not the entire capital stack, right? You still have the return on your equity.
Yeah, so you're losing less. It's amplifying your losses, I guess. Yeah, fair. However you want to think about it. It's not smart business, right? It doesn't make a ton of sense. Unless, of course, there's some sort of upside. And I think that's where it gets really interesting is what kind of duration are you looking at on your upside? If you truly believe that interest rates are going to stay where they are for 18 to 24 months and then come back down, and you can get an appreciation of rents over that time frame, will you be willing to kind of look through the next 18 to 24 months, knowing that in 24 months, your cost of capital is going to come down and your rent will have appreciated. And all of a sudden, that 4 cap you bought today at a 4.5% interest rate environment becomes a 4.5 cap at a 3.5% interest rate environment in 2 years from now. And now all of a sudden you created 100 basis point positive leverage. And now you're in a really good position. I think there's a lot of people out there right now that are taking that stance, that I'd rather be active and be in a good position in 18 to 24 months than be inactive and wait for somebody else to take advantage and be in that good position in 18 to 24 months. I don't know. That's just my instinct.
Well, that's a perfect segue to the next question. What is that yield curve telling us? We've got 5 and 10-year Bank of Canada bonds right now basically on par. Should buyers be taking shorter term notes with the expectation of lower rates in 2 to 3 years, or do you see higher rates persisting for the long term?
The murky crystal ball. Well, I mean, it's funny. I mean, we referenced interest rates a couple of times now, as being expensive or pricey. And for sure they are. If you think in the context of back to summer of 2020, yeah, this is a dramatic change. But if you look 10, 20, 30 years back, interest rates are up. But by no means is this a cataclysmic event. It's really only problematic if you bought at a 2 3/4 cap in a tight market when interest rates were at 1 something%. You thought, hey, I got positive leverage, I'm good to go. The interest rates now are not the death of the market. And so if you're of the view that we're out of the quantitative easing of the pandemic and we're going to be in some bandwidth of more normalcy, then we're kind of, we're in that range right now anyway. And so if you were inclined to go longer term debt, because the yield curve is so flat, meaning that the difference between the 5 and the 10-year bond is very minimal, and therefore your interest rate difference between a 5 and a 10-year term is pretty minimal, then you're probably good to jump into a 10-year term debt because you're paying very little extra for that surety, and you don't have to worry about a shock to the system at the 5-year mark if we're back into turmoil. So I am seeing in the deals I'm working on a return to 10-year. When everything blew out, everybody's gut reaction was, okay, 5-year only, 5-year only, 5-year only. But now that there seems to be a little more stability in the market, and because the difference is so flat, Aaron and I were just looking at this earlier, you're at a handful of basis points difference interest rate between the two right now. People are getting back into 10-year. So it really depends on the goals for the money, just putting something to bed, not having to worry about it, or do a 5-year and play the bond rate game and see where it goes.
I agree. Really interesting. I guess I'll do the same fence sitting as Adam. I don't know, up or down, I'm not sure. Nobody knows, of course. Do you think that the inflationary environment we're in is predominantly a result of supply chain issues? Yes or no? Do you think those supply chain issues can be rectified more rapidly than other larger fundamental issues with the economy that drive inflation? Yes or no? And then with the inevitable recession on the horizon, is that going to be a minor or major recession? I heard someone say today that investors or the market at large is looking through inflation at the recession, right? Because typically in a recession, there's a flight to safety, meaning people typically sell their stocks and buy their bonds, to put it simply. And when people buy bonds, bond rates come down. It's a simple formula. It's not simple, but in that context it is. And so we've seen the last sort of 35 basis points rally in the bonds, meaning a decrease in the interest rates. Is that what's going on? Is people just predicting a recession and coming down? We are seeing an inverted curve in the long end and the short end. I think someone said to me this morning that 3 years more expensive than 5-year. 5-year and the 10-year Government of Canada bonds are about equal. So that would indicate flattening of the curve in the long end, an inverse at the short end. What does that mean? I don't know, right? There's so many variables. And then the other one is, of course, we still do have whatever it is, north of 7% inflation. The Bank of Canada seems to indicate they're going to continue to rise the overnight rates to battle that inflation. The bond market prices in, quote unquote, I'm making air quotes here, the Bank of Canada overnight rate increases over time. So in theory, the current Government of Canada bonds already include the rising overnight rates by the Bank of Canada into the future, in theory. So there is some chatter.
They built that in back in March, April, May. They built it in
April,
then.
May, yeah. So they built it in, but they didn't predict the 100 basis point rise we just saw in July. They thought it was going to be 75 basis points, but even at 100 basis points, really didn't move the bond market, didn't change anything on yields. I think the target right now that they're predicting or projecting, or that it's, again, quote unquote, priced in is 3.25% is the overnight rate. Right now we're at what, 2.5, something like that. I guess my answer is it's super complicated, but in theory, bond yields have kind of maxed out as a relation to the inflationary environment. So if you think supply chains are a major contributor to inflation, can that be rectified more rapidly just a result of just working the supply restrictions of the supply chain through, which would then obviously cause inflation to come down more rapidly? And then all of a sudden there's no more inflationary environment. So it means the Bank of Canada's rate rising regime ends. And then all of a sudden we jump into a recession, which means a flight to safety. So could we have already experienced the plateau of bond rates? And now we're on the downward shift into a recession where rates come down? I don't know. Who knows, right? But you certainly hear people talking about the 3.5% Government of Canada bond we saw 45 days ago, that was the ceiling. And that now we're on the other side. Again, who knows, right? It could be negative in 6 months. It could be 6% in 6 months. Like that's the most comfort I can give your listeners.
I like the bandwidth. You'll be right. I can guarantee that.
I wonder if the Bank of Canada overshot with the last increase. Hopefully we start moving from pandemic to endemic over the next year or two. And who knows, maybe over the next 12 to 24 months, enough elements of the supply chain may have self-corrected to the point where the 100 points wasn't necessary. I mean, who knows, right? Obviously, 8% inflation needs to be stopped, but there's a difference between inflation and inflation expectations. And the bank had to make a strong move to show that they're serious about bringing inflation back down to that 2% goal. But if the bank had time on its side, which it doesn't, it may have been the case that a good number of the supply chain issues might have self-corrected. The bank's policy rate is now at 2.5%, which is right in the middle of that neutral range of 2 to 3%, which theoretically is supposed to neither stimulate nor restrict growth. But the next increase, which we're hearing will probably be in the 50 to 75 point range, would put their policy rate at the top or slightly over the top of that neutral range. What are your guys' thoughts on further increases?
Benjamin Tall, who, selfless plug, Ab and I had on the podcast about a month ago now. Benjamin Tall is the chief economist for CIBC. He was saying 2.5, they should just stop now. Let's just stop and just see what happens, because he believes that inflation is really a supply chain thing and it will work itself out regardless of what we do with interest rates.
And he called the bond market peak too, I think, around then. And he's starting to look pretty smart with that call.
And many, or perhaps even most of the factors driving inflation are global issues, right? Or at least not strictly domestic issues, which are outside of the bank's control.
It's impossible to know. But I can say, circling back to interest rates and mortgages in particular, is there are lots of ways to mitigate that risk. And it really depends on your philosophy. Depending on what you think is driving inflation, how you think the recession is going to impact our economy, and what you think about the Bank of Canada and where it's going, that should drive your strategy for taking on finance, right? And I am seeing some people, Adam talked about people going 10 years, right? Just saying, you know what, this mitigates the risk that I'm perceiving. So taking a 10-year mortgage, which is effectively equal to the 5 years. So why not get an extra 5 years of interest rates for the same price? And on the flip side, we're also seeing some borrowers looking for 2-year term, thinking that I'll just lock it in for 2 years on the prediction that in 2 years, rates will be down materially. And therefore, it makes sense to take a 2-year term and then in 2 years, refinance into something longer at lower interest rates. I mean, the risk with that, of course, is that, as everybody knows, it's not an easy process to go through financing. There's a whole bunch of transaction costs, obviously money that it costs, paying lawyers and third parties and all that kind of stuff. But it's also just time consuming too. I think that it sounds easy. I'll just take 2 years. In 2 years, I'll just take it. Now, you run the risk interest rates are even higher in 2 years. And you run the risk that they're the same or flat. And now you're just going to pay a whole bunch of additional transaction costs. that were unnecessary when you could have just done what Adam was saying. Some of his clients are doing is just take 10 years. I'll just deal with it in 10 years from now. I'm still happy at the rate today. I think that's a macro. I mean, it really depends on your perspective. You're looking at this from a 30-year perspective. They're still really cheap. If 20 years ago I said, hey, I can give you a 10-year term at whatever it is, what's the rate today? 4.35%. I think 10 years ago, you would have been like, oh my God, like give me as much term as you possibly can. The fact that people are balking at that, saying, oh, it's so expensive, is a bit short-sighted as far as I'm concerned.
Guys, we should talk a bit about the new CMHC Select program that rolled out this past March, getting a lot of attention because of its incentives related to affordability, efficiency, accessibility. Can you fill in our listeners on the opportunities available specifically in that program?
Yeah, sure. So CMHC Select replaces the CMHC Flex program, which ran for a handful of years prior. And that was a program that rewarded buildings with affordability component, with superior underwriting, some discounts on premiums. And in terms of construction, you could also get into your term portion much earlier. You didn't have to lease up. So it had a lot of attributes, but it was restricted to just buildings that had to focus on affordability. And then Select came along and it looked to broaden the number of social outcomes that you could look to achieve, and included energy efficiency, and it also included accessibility. And of course, the ever-present affordability. This program is offered to both construction to term and to just term borrowers. It's a little more complicated than the previous system, but if you want to think about it in kind of broad terms, there is a grid system that rates how energy efficient, how affordable, how accessible your building is. And the more you are in any of those three categories, the more points you obtain. Then there is an accompanying grid for that, depending on how many points you've achieved, you get an increasing number of benefits for having done so. That can include higher LTVs, that can include non-recourse, lower premiums, and longer amortizations, whether it's 40, 45, or 50 years. But it also includes a lower DSCR underwriting rate. So the end result is you can borrow more money on the same NOI. It interestingly got launched, as you said earlier, on March 7th. And that was within days of the bond rates taking off. So all the underwriting that all the lenders did leading up to that launch date, and when First National and others all had quite a bit of it to get ready for the March 7th launch, it shifted the world. Right after all these files went into CMHC and loans were in the 90% LTC range, it was very favorable financing. But of course, debt service coverage limits, virtually all loans. And when bond rates skyrocket as they did through March and into April, of course, loan amounts did come down. But you're talking about loan amounts coming off of financing that wasn't even possible prior. So even in the interest rate environment we're in now, Select is a great tool to still get a loan that works pretty well with your building. Under the construction program, there it's pretty straightforward. In energy efficiency, you're just using the NECB 2017 code as the base and how much you'll perform that. If you are doing an existing building, you just take how the building currently performs. You would then put together a package of planned upgrades to the property, and a consultant will tell you how much more efficient you're going to be, and that determines how energy efficient you are. On the affordability front, it's all based on median renter income, and there's numbers for every city across Canada. You can download it on the CMHC website. And if you have a certain number of units below that threshold, then you get additional points there. In terms of uptake, on the construction front, it would be near universal. It's a great program for construction, and we're seeing most construction projects going that route. On the existing building front, less adoption, but still significant movement. As compared to the previous program for existing buildings, there was not a lot of uptake in that stream. So there's been market increase in that category, and it does work well. If you're planning on doing upgrades to a building, it's going to impact energy efficiency, and that can be boilers, that can be windows, that can be LED lighting, can be any number of things. You're going to want to pair that with the financing if possible, because there's a very generous CMHC program that goes along with that. So in terms of the mortgage gods looking out for us, releasing that program within days of the bond rates starting to flirt with their upward trend, it could not have come at a better time. And if the goal of the program, CMHC's was to get adoption in the marketplace, it's been a huge success in my mind.
A couple of things I add. One of the things I think is really interesting is that in some secondary markets, I did a speech for the Kingston Apartment Owners Association. That's not the acronym, but you get the point. And in preparation for that, did some research, and the average rents in Kingston are below 30% of the median renter income in Kingston. So just by having average rents in your apartment building, you automatically qualify for 100 points under the MLI Select program. So with doing 0 to your building, you automatically qualify for the significant discount in premiums and get all the attributes of a longer amortization, higher leverage, et cetera, et cetera. I mean, I guess the caveat is then you do have to maintain rents at that level for 10 years. But again, you've just been operating your building status quo and are at that level today. So I feel like that 10-year restriction on increasing rents substantially isn't really an impediment given the value you get for maintaining rents at that level.
Yeah. Well, it's worth mentioning, Aaron, that you can rise with the guideline increase every year. You just can't reset to market if you rent up your unit. But it sounds like if the median renter income and actual rent are pretty much aligned, that's somewhat irrelevant because you're not missing out on some enormous rent bump.
And so if the affordability component is not attractive for whatever reason, because you want to be rising rents, there's still lots of ways to qualify. The energy efficiency, to Adam's point, is probably the best because you can pair your financing with the capital expenditures that do drive energy efficiency. And so the refinancing, of course, releases the capital to cover that CapEx. We're also finding there's some value in the accessibility side, right? Where certain buildings, just by virtue of zoning requirements or permit requirements at the time, or just by their design, by being long and flat, and so having a single floor or what have you, allow them to qualify for points on the accessibility side. So I think no matter what, you would be doing yourself a disservice if you aren't investigating how your existing building could qualify. Because all you need is 50 points. I mean, you go on to call your First National rep or call Adam if you don't have one to just ask about how you can qualify because the points are varied. But as you add up the points, get to 100 and you can get a whole bunch of incredible. I mean, the premiums is the best one, right? As far as I'm concerned, because it's 1.25%, right? For existing properties at max leverage, Adam?
We go down to 1% if you're doing max with stabilized building.
Yeah, right? Rather than 4.5% premium, you pay 1% premium. Just do the math. On $1 million financing, that's $10,000 out of $45,000. There's a $35,000 savings on fees alone. Not to mention you get higher leverage and a longer amortization. So more proceeds in your pocket, less cash flow. So more cash on a monthly basis in your pocket, and you pay less fees up front. Like it's a win-win-win. It's a great program. And so again, to my point is if you're doing financing and your broker or your lender is not talking to you about MLI Select, go and talk to somebody that knows about it.
Yeah, it's potentially one of the few truly positive things that have happened lately for apartment developers. The affordability side may be tough because of bloated construction costs driving the need to achieve higher rents, but for new builds, certainly the energy efficiency piece is already there and the degree of accessibility can be designed in depending on the goals. The nice thing is that it's a grid point system. It's not all or nothing. For new builds, you may qualify based on efficiency and accessibility, but not affordability. Older buildings may qualify based on affordability and then retrofit for a higher energy efficiency, but lack on the accessibility side. Lots of ways to approach it and lots of ways to benefit from it.
Yeah, Google MLI Select and it will be the first thing that pops up the grid with the points and then you can figure out. But again, there's lots of nuances to it. Navigating through the CMHC process is complicated. And so you really should get yourself an expert to help you with that process. It is not as simple as put a package together and submit it and get your CMHC insurance. It's just not that simple. The other comment I'll make that I think is interesting on the development side, we are seeing a lot of, to your point, it is harder to get into a development and think about maintaining units as affordable because of the decrease from new market rents for new builds versus what you would need to achieve to maintain that 30% of median renter income. However, we've found a lot of our clients, if they're serious about MLI Select, serious about affordability, and they're embedding this into their project from day one, meaning they're not showing up with the building 80% built and then saying, okay, I want to get my financing. They're thinking about their financing strategy at stage one. While they're talking to the architect, while they're looking for land, this is embedded into their process because there's a lot of value with the cities, with the municipalities as well. If you show up at a municipality saying, I'm going to deliver X proportion of my units as affordable and maintain them as affordable for 10 years, because that achieves a much better financing, you're also going to get preferential treatment out of the city, whether that's through expedition of approvals or some sort of leniency on whatever it is, depending on the municipality. So there's lots of benefit to really trying to embed this approach as early into your development as possible.
Well, and in the planning stage too, if you're looking at energy conservation options that maybe some that were borderline financially viable. Well, now you layer in, I'm going to get better financing if I do it. Well, now the economic case for it goes up quite a bit.
Yeah, that's a really important point, Adam. Thanks for adding that. Well, that's great, guys. Thanks again for being on the show. Do you have any final words or parting thoughts for our listeners before we wrap up?
Yeah, I mean, the other thing that we're tracking right now is renewal risk. And so this, of course, would apply to people that got a mortgage, at any point in the last little while. And of course, their interest rate is much lower than what it would be if they were going to get today. And they've got a maturity coming up in the next short while, and they're facing higher interest rate risk. The risk isn't just they're going to pay more for their mortgage, which they likely would under just a straight renewal scenario, but they also might not have had the NOI keep up with the mortgage requirements for that renewal. So you are going to have loans that run into that issue at maturity that they just can't debt service with the same outstanding balance, but with the higher interest rate. And so we're looking now at a couple of different options to help people through that. One, of course, would be re-amming a mortgage. You go back to CMHC, apply for what is essentially a new mortgage, and you're pushing the ammo. Because, of course, if you did a mortgage 5 years ago and it was a 30 AM at the time, now you got 25 left and, your NOI hasn't gone up the way that can support new debt. Pushing out the amortization does help it. Because for anybody, I'll get right down to kind of mortgage borrowing 101, debt service coverage indicates that if debt service coverage is 1.2, you essentially need $1.20 worth of NOI for every dollar worth of mortgage that you got to pay. So that's the ratio you have to maintain. If your debt cost goes up, you need, of course, your NOI to go up along with it to maintain the same debt levels. So if you take an AM that is now 25 years of renewal and you go back and you refinance it at 30, 35, 40 years, depending on the state of your building, you're going to get back on sign with that debt service coverage ratio. So that's kind of one escape route for what it could be an impending risk for some borrowers. The other one would be early rate lock. We're doing a variety of early rate lock structures right now. Our standard is up to about 3 months, although we do also have an early rate lock option up to 9 months. It is just for larger loans, call it 20 million plus. And there's some complications to it that I'd be happy to walk anybody through that wanted to discuss it. But let's just save our discussion points now, the more straightforward 3-month early rate lock. If you had a maturity coming up in the next few months and you see what happened last week in the bond market, bonds have gone down substantially. You've been seeing them go down for weeks now. And all of a sudden you want to rate lock. It'd be 2 reasons. One, you're trying to capture a low interest rate, and that's great because it impacts your cash flow and your borrowing and your mortgage cost. But it could also be the difference between being on-side or off-side on your mortgage at renewal. If you were close in terms of your debt service coverage, but off-side, we have a dip. Well, hey, I got this 3-month option. I'm going to jump in right now and just lock rate so I don't have to worry about it. So it's not just about trying to save money. It's just being able to not bite your fingernails between now and your renewal date because you're watching bond yields kind of fluctuate around on a potentially hourly basis. So early rate locks got the benefit of just taking risk off the table and helping you sleep better. Then the last one, of course, would be, Select, as we just discussed. Maybe you're offside on your debt service coverage, but you were planning on doing some upgrades to your building. So this would be a good time to go to CMHC, take benefit of the new program and the different underwriting parameters that can accommodate the NOI that you've got on your building and make a loan work where it might not work under the market program. But there's only a little foresight. If your renewal's coming up in 6 months, a year, start thinking about it now, start talking to your lender, they start doing some underwriting and, manage and watch that risk.
It's funny, Adam, it is amazing to me. Our renewals team, the team that monitors our maturities, it falls under the operations group, and being the largest lender in the country. We never even talked about First National. Hopefully people appreciate who we are. But largest lender in the country, largest apartment lender. On top of that, we've got $40 billion under administration in the commercial side alone. With that comes 1,500 loans maturing every year. And it is amazing to me how often, and Adam would see this too, talking on the client side, where you get clients showing up 3 or 4 weeks before maturity being like, so what do you need from me? And it's like, no, we should have had this conversation like 8 months ago. Like, it's not that easy of just send me an email saying you're okay to proceed with the new deal, right? It is a lot of work, whether you're doing a straight renewal or, in this environment, there's a lot more challenge to that balloon risk. So whether it's for First National or any other lender and you are an apartment owner and a borrower of mortgages, please engage your lender early. Do us in the lending community a favor to help us get to a solution before the maturity date.
We have solutions, but they take time.
Exactly. Lots of solutions, but they take time. Exactly.
Yeah.
Thanks again, guys, for your time. If any of our listeners wanted to reach out and get hold of you, how would they do that?
I'll throw my email out there and see what happens. Adam.Powadiuk. My last name is Powadiuk at firstnational.ca. I'm always happy to chat real estate.
We'll get that up in the show notes as well. Adam and Aaron, thanks again for your time.
It's been fun being on the other side of the microphone for once. Thanks for having us on here, Derek.
Yeah, thanks, Derek. Really appreciate it.
Thank you for listening to the Ontario Multifamily Investment Podcast. If you enjoyed today's episode, please help spread the content by rating and sharing it. If you'd like to receive future episodes, please sign up at ontarioapartmentgroup.ca/podcast. If you'd like to speak with me directly about buying or selling apartment buildings in the province of Ontario, you can reach me at derek.green@ontarioapartmentgroup.ca or online at www.ontarioapartmentgroup.ca. Until next time.